All right, I'm recording now. All right, so today we're going to go over, take a big picture look at the market, and go over some of the strategies and look at how we actually eliminate losses and minimize the number of losses, and how we also improve profitability on certain trades where you would normally expect maybe a 15, 20 something percent return that can become a 40, 50, 60, 80% return, with the using the big P word, patience. Patience is key for to get the bigger returns on trades that would otherwise not be a big return, but yet profitable. Right. So, everything we're talking about today is for educational purposes only, not giving any specific trading recommendations. What we'll be showing you is how myself and Becky, who's the co-host, how we've been trading for a little bit more than 20 years now. We have been trading pretty much the same way as far as options go since maybe 2007 or 8. Hasn't really changed much since 2008 as far as just buying calls and puts and how we manage positions. Our management has really not changed. Once we find something that works for us, we stick to it. The strategies might change, but even with a new strategy, the trade management position sizing is all the same. That has never changed in a long time. We might fine tune strategies for more trades, but the trade management and expected profitability has stayed the same. So we're very confident with what we do because we've been doing it for many years now. All right. So you're going to see what we do is very analytical. It's by the numbers. These are the only ETF markets or sectors we trade. We chose these sectors to create diversity in portfolio and trading. And in a little bit, I'll show you why that diversity is really important and key to having net profitability. There are probably 1,000 ETFs out there, all covering the same type of sectors. We chose these in particular because these have enough option open interest to make them tradable. There might be other ETFs out there covering the same sectors. However, the open interest on options might be one contract or none. These are very tradable with options, so that's the reason these are on our list to want to trade with options, as opposed to any of the other 1,000 ETFs out there with similar sectors in common. Right? So that's the reason for this selection of ETFs. Also, the pricing of the options can range anywhere from $70, $60, $70 up to 1,000 something dollars per contract. So there's something in here for everyone's budget. So not everyone has a huge, massive account that can trade by several calls on DIA at 1,000 something dollars a call. Not everyone can do that. And we always trade in the money options. Some people have smaller accounts. Well, you're going to have to trade ETFs that have option prices in the hundreds of dollars rather than the thousands of dollars. But it's something here for everyone. Okay. So that's reasoning for this particular list. I used, which we're going to go over today, you're going to see in the handout. Let me put another link for the handout. If you look in the chat window, you'll see the link for the handouts, the chat window. So you can just go to that page and download the handouts. But what we're going to look at is numbers and wins and losses on different sectors, on different groupings of sectors. So we're going to be looking at what if you only traded without strategies, you only traded the indices, the Dow, Nasdaq, and S&P. What if you only traded metals,
Now.
that type of thing? What if you only traded energy stocks, oil, gas? So that's the stuff we're going to be looking at. And I've also noticed that people think that if they see something here that says 91% wins, that they think it's going to be 91% wins every single year. That is not the case. 91% wins um, we might show 91% wins on a particular ETF, but that's over 20 something years. Any particular year might be more or less. It averages out to that amount, but any one particular year can be more or less. And I'll be looking at that and showing you some examples of that and things to think about. And yes, Rob, they're all swing trades. I have not looked at an intraday chart since 2009. I've had no reason to. Everything we do is on daily and weekly charts. So no reason to look at intraday charts at all. But we usually start out this meetup by going through the big picture view of what's been happening in the market and then drill down to what's happening now. How long are these swing trades? Yearly, monthly? You put them on, and most of the trades hit the target within 1 week to 5 weeks. The option life is usually 1 to 3 months for the life of the option, but most of the trades take between 1 week and 5 weeks to actually reach the target. All right, I'm going to switch charts and I'm going to switch to the big picture monthly chart. Let's take a look at the markets and see what's been happening, and then we'll come back to this and the numbers, because everything, we live and die by the numbers. And just so you know, anything you see in a spreadsheet in a rectangular box is created by Becky. Becky is a data manager. That's what she's been doing for a living for a long time. So working with her is perfect because you will not hear her speak on these meetups. I'm the person that likes to be doing a presentation. She likes to be the person in the background, taking care of all the numbers and all the stuff that actually makes everything we do work. So anything you see in spreadsheets, numbers, that type of stuff, Becky's the one who plans all of that and keeps the stats. And we need this for our strategies and all our coaching clients. These are the numbers we need to trade, to know what to trade, when to trade, and what to not trade, especially what to not trade. Right. So key to have all the numbers. So I'm going to switch to the chart right now, and then we'll come back to the numbers and what's been happening. All right. So what you're looking right now is a monthly chart of S&P 500. Monthly. So every one candle is 1 month of time. Right now, this is 1998. 1998. All right. This blue line is a 40 period simple moving average. Monthly chart, simple moving average, 40 period. This is an 8 period moving average. Okay. Actually, it's an EMA, I believe it's EMA actually using. And this is an 8 period, and this is a 20 period. So in the big picture, this was the crash of 2000 when the market crashed, tech crashed. Um, when we see two consecutive negative closes below the 40, we can expect the market to probably go lower, and it did. This was the crash. And you'll notice when it's above the 40, it tends to ride the 8. It goes above the 8, pulls back to the 8, pulls back to the 8, pulls back to the 8. Eventually, a couple closes below it, it'll drop back to the 40. These are all monthly charts. Two closes below, and then it runs again. It retraces back up to the 8, retraces back up to the 8, retraces back up to the 8, retraces back up to the 8. When we are looking at daily chart trades, those are key opportunities. Every retest of the 8 is a shorting opportunity. Every retest of the 8 is a shorting opportunity from our daily chart trade signals. So we'll talk about that a little bit later on, how to time stuff to actually maximize some profits and turn potentially small trades into much bigger trades. The 8 is a 8 period EMA. That's this orange gold colored line. So going back to what we started, how I started out, and Becky also, it goes back to John Carter, Hubert Centers trading the 8 EMA and 20 something EMA moving average crosses, and that's kind of in our foundation. And trading off the 8 was a foundation thing. And then even when we went to bigger time frames, we found it was still applicable. You'll see the 40 period moving average on just about every chart we have. That came about from Oliver Velez, started listening to him, following him. And He explained how we used the 40 and we started using the 40 and it's become a foundation on all of our charts to give us trend and also a line in the sand for bullish or bearish, and also if the market's going up or down, it'll the 40 is also a good indication of that. So you'll see a 40 on all of our charts as a line in the sand or a guide to direction. All right, so once we got a bullish cross of the 8 above the 40, price went back up. So this is all the crash of 2000, and then we went back up. This is 2004, price is back above the 40 and above the 8, and it pulls back to the 8 and bounces. Every year and a half, 2 years or so, we'll see a major pullback to the 40. For the long-term investors, this is an optimal buying opportunity on a pullback anywhere around the 8. You won't get an exact value, but anywhere you set up your long positions for the long-term investors. Remember, this is a monthly chart, not daily, not intraday, monthly. So anywhere in this area is a buying opportunity for the long-term investors. We get trade signals on our daily charts all the time. You can't be in every trade, so I usually just wait. If I might get a buy signal up here someplace on a daily chart, but then the market starts pulling back to the 8. So then I'm not in a big rush. I'll take the signal I got up here, I might take it down here somewhere closer to the 8. Just I'm willing to miss a trade to catch a much bigger trade, basically. So, and we'll talk about that a little bit later on. Pull back to the 8, buying opportunity. Buying opportunity. Every couple of months, any pullback is a buying opportunity. So when we get our daily chart, remember this is a monthly chart. So when we get our daily chart trade signals, I'll try to hold off on taking those daily chart trades until I see some kind of pullback to these levels. All right. All right. So this is we all the way up to 2008. That market crash where the market literally dropped 50%. The S&P dropped 50%. Okay. Two consecutive closes below the 40. And just like in 2000, two consecutive closes, the market goes lower. Okay. And retrace back up to the 8, another opportunity for shorting. But you're going to see many sell signals on our daily charts. So on this whole period, we see trade signals on our daily chart. For people who I'm working with as coaching clients, I usually go through from the middle of 2007 until the market went back up in 2009. We go through every single valid trade on the daily charts on the major indices and see how if we were trading our strategies during that time when the market was getting crushed, how well would we have done? And it's usually about 93% winning trades. It may be even higher. Realistically, it's about 95% winning trades during this time when the market got destroyed. No matter what you trade, you want to go back, take a look at that strategy between middle of 2007 and the middle of 2009. Run the numbers, do your back test, whatever it takes, whatever you're trading, whatever strategy, grouping of strategies you're trading. How would you have done during this period when the market dropped 50%? Realistically, most strategies fall apart when the market is bearish or sideways. So you really got to, whatever you want to trade, make sure you can still make money whether the market is going up, whether the market is going down, or whether the market is going sideways. Will you still be making money that year? And that's key to looking at strategies because a lot of them fall apart. Most strategies work okay on the long side. Most, if you know how to manage it properly, but on the short side or sideways, most just fall apart. Okay. So this whole 2008, the market dropped 50%, rallied back up above the 8. And once it's above the 8, it just rides the 8, rides the 8, rides the 8, rides the 8. And here, price finally gets back above the monthly 40. And every 18 months to 2 years, we get a pullback to the 40, uptrending 40. And we've been in this massive uptrend since 2010. Hasn't changed at all, at all. Massive uptrend. The periodic pullbacks, to support levels, takes off again. Long-term investors, anywhere in this area is where you get your positions for long-term investors. Daily chart people, which is we all are, every pullback to the monthly eight super buying opportunity, you don't have to wait for the monthly eight, but if you're looking for some bigger profits, monthly eight's a great place to look for trade pullbacks. All right, here we are in 2015. We pull back to long-term support. Once again, long-term investors, you should be salivating when you see the market getting crushed because you're just waiting for the opportunity. Waiting for the opportunity to get in anywhere here because you know that's coming next. Anywhere here you're waiting to get in because you know that's coming next for the long-term people. All right. Here we are, 2018, another pullback. Once again, riding the eight all along, monthly eight. Another pullback. And keep in mind, this monthly eight is a monthly chart. So when you're looking at stuff on a daily chart, you have your second chart of the monthly, you know what the levels are. So anywhere close to it, buying opportunity. Pullback. This was COVID, the beginning of 2020. This was literally only 3 weeks worth of dropping. This drop only lasted 3 weeks realistically. And then we had the massive, biggest rally ever in history. All right. Everyone thinking, oh, everything's shutting down. It's gonna awful. The market just needs a reason to pull back, and it's very technical, very predictable. It pulls back to support levels and goes again. Pulls back to support levels. Okay. Buying opportunity. You had a couple of months worth of buying opportunity to set up positions for this. Tariffs. Oh my goodness, tariffs. The market's going to go down forever. No. Market just needs a reason to pull back. It just kissed the uptrending. We've been in this massive uptrend since 2009. Nothing's changed. We just have the periodic pullbacks every couple of years to long-term support. This was a big, gigantic red candle. And people think it's going to go down forever. We talked about this a few months ago. If we had gotten two closes below this, then yeah, it might go lower to the next support levels. But we didn't. It just kissed it, took right back off. Okay? That's why I always look at the big picture, not the doom and gloom they talk about on TV. Those media organizations just talk about literally what's happening in this moment in time. They don't look at the big picture. They don't want to see the big picture. But if you understand the big picture, you look at when the market is getting crushed. When the market was somewhere here, I had to meet up, I think it was April or May, or March or April, and I was telling people, we need to wait for the market to drop about 10% more, because 10% more would have brought us right to here. 10% more, and I know I had someone who messaged me just after the last meetup and told me they did just that and they got in some call options on the Dow right down here, and they had a massive, massive, massive return because they literally rode that trade up and just stayed with it. Um, that's the opportunity. It only comes up once ever so often. So when it does, you look for it and capitalize on it. Use our signals from the daily chart strategies, but time it with the monthly, and that's the major, major opportunity. Basically, one win from this trade is equal to 3, 4, 5 trades wins from the daily charts if you, without one particular trade getting in just the right time. All right, so that's the big picture. And along the way, if you have a question, just unmute and ask it, but don't raise your hand. Just either type it in the chat window or unmute and ask. And I'll put in chat window again, the handouts, if you don't already have it. You can download it there, and also the link to where we put the recordings of all these meetups.
So how do you know when to enter?
Okay, we'll go to the daily charts of trades, and we'll look at that in a little bit. I'm gonna switch charts now. Change the share. Okay. So Okay, first let me go to the handout first, take a look at that, and then what I want you to understand, then we'll come back to the charts here and show you the strategy, one of the strategies, because we trade a group of strategies. So let me change, hang on a second, share. All right, once again, this is stuff that Becky does. It tracks every ETF we trade in every sector, wins and losses. Everyone has access to this list of wins and losses for the last several years. It's on our website. How you choose to sort it is up to you. How we choose to sort this for this meetup is showing what happens if you trade certain groupings versus certain others and what to expect. Okay. So this particular grouping we're looking at right now is metals and mining. So GDX, GLD, gold, SLV, silver, the mining companies, those metal mining companies like GDX and XME, those ETFs. There's like a grouping of ETFs related to metals and mining. Okay. And we do the what if. What if we only traded the metals and mining? And I want to go through this and show you the importance of diversity in what you trade because that helps the numbers. All right, so from 2019 to 2025, if we took all these, every single valid trade in these four ETFs, it's 85% wins, all right, 15% losses, 325 trades. Sounds great, no problem. For so far for this year, 12 trades, 12 wins. And a win means it reached the first target before expiration. There's usually at least 2 months worth of time in the option, at least. And we give you choices for that. 2024, 93% wins. 2023, 88% wins. We don't touch anything under 84% wins for any individual ETF. Okay. But let's say you were trading this grouping of ETFs in 2022, but it's only 78% wins for this particular grouping of ETFs. Okay. And we broke it down for each individual ETF, what happened that year. On GLD, it was 10 trades and half were losses, so on and so forth. But overall, to train that group, it was a lower overall percentage of winning trades. And at 78% wins, if you was trading that grouping, you might make money or you might not. It's going to be close whether even net profitable. We really want to see about 85% winning trades to guarantee. Since we don't know how much money we're going to make on an option trade, you don't know. Options are not linear. When it reaches the first target, you do not know what it will be worth relative to what you paid for it. You do not know. A trade could take 10 minutes, a trade could take 2 hours, a trade could take 2 days, it could take 2 weeks, it could take 2 months. You don't know once you place the trade, you don't know how long it will actually take to reach the first target. So there are lots of variables with option pricing. But let's say 2022, 78% wins. If you're only trading this grouping, you're probably not going to make any money that year. It might be break even, might be slightly positive, might be slightly negative. We're not going to really make much at 78% wins because we know that the sweet spot is 85% wins or higher to actually be making any significant amount of money relative to account size. Okay. Well, let's say 2022, trading the metals, kind of flat. Well, what if you also in 2022 trading the energy stocks, the energy ETFs, UNG, gas, USO oil, XLE energy ETFs, XOP oil. 2022, you had 93% wins. The diversifying part comes into play now. If you were just trading the metals, you didn't make any money that year. But if you're trading the metals and the energy ETFs, you did well because the extra wins from this sector offset the other one, which didn't really do anything noteworthy. So you didn't really make any money on the other ETFs, but on the energy sector, you did really, really well. So by having diversity in your trading, you end up making money. In the same 2022, let's take a look at real estate ETFs. 92% wins for the real estate ETFs. IYR, VNQ, and XHB. Those are the three real estate ETFs we trade. Okay. Once again, diversity so that something is always making you money. We don't know what in any given time will be the one that's making you money and one that's not. That's why we try to have diversity in our trading. Something will always be making you money. So, and we will always have more winners than losers. So, if you have diversity, you see the win loss percent is 88%. This is for the real estate ETFs and XHB home builders. 88% wins overall in the last since 2019. And by the way, our actual stats go back all the way to 2000 to 2006, depending on the ETF. Um, I only asked Becky to assemble this so that people can see from different viewpoints what to actually expect from the trades because we lay the information out so that people can get a more of a reference of realistically what to expect when they trade certain things and not just otherwise everything is just generic. But when we lay it all out like this, people can really understand, okay, if I do this, okay, now that makes us to make more sense in trading. So when I lay it all out like this, you can see how really good trading the real estate ETFs are. It's always, always, always a pretty high year winning percentages. So it's really good to trade the real estate ETFs. And some people might want to specialize in those. And the prices are actually of the options are not that expensive. So for a couple $100, you can actually set up some really nice trades and create some nice profits with a smaller account. So that's the benefit of having the diversity with because you may not be able to afford the big ETFs like the SPY, DI, and QQ because they're going to cost 3 to 4 times as much as these options for an in the money contract. Okay, so really good to trade real estate. Now, if you want the absolute best results, you trade the Dow, S&P, and NASDAQ. With our strategies, and it's a grouping of strategies that I'll show you one of them in a little bit with the entry target and that type of thing. But we trade, that's just one out of 6 foundation strategies, and then we have 2 additional strategies that's just for the Dow, Nasdaq, and S&P. So we have 2 specific to the Dow, Nasdaq, and S&P, and the other 6 are for that full grouping of 28 ETFs. But if you just want to make money and you have the enough capital to do it, focus on the Dow, Nasdaq, and S&P. 2019, 2025, overall 91% wins. That's long and short. Okay. 2025 so far for this year alone is 91% wins. 2024, 95%. 2023, 87%. 2022, 81%. 2021, once again, 2022, when you trade one with the other, it so that 81% becomes higher because you're trading more than one type of sector. 2021, 95%, 2020, 93%. 2020 was the best year of trading ever with COVID. For whatever reason, everything that's worked, it was just beautiful. Whether futures or options, this was my most profitable year of trading was COVID year of trading when everything else was shut down. The markets don't shut down. The markets are still moving. As long as something's driving it, we don't care if it's up or down. Direction means nothing. Our strategies capture market tops, our strategies capture market bottoms, and our strategies capture markets in the middle, trending, not trending, or sideways. It works beautifully. It's just a matter of trading consistently and capturing profits. But you can see, regardless of what we trade, the indices have the overall best results. And when you break it down by individual ETFs, you can see those numbers also. So the indices have the absolute best results. So
How
if
can
you
we trade with you?
say that again,
How can we trade with you?
Okay. My information is in the handout. And all you got to do is call me or email me after the meetup, and I'll go through that with you. But details are in the handout. I'll go through that at the end of this meetup. Now I'm going to switch back to the chart and go through one of the strategies, and I'll show you how we enter trades and generally speaking, how we manage trades. Let's see, share and SPY. All right. Some of you have seen this before. Blue lines, always my 40 period moving average. It's the daily chart now. This is the S&P 500 SPY. Orange line is a Donchian channel mean line. The Donchian channel actually has three lines, but we don't use the other two, so we're not showing them. This upper line is a Bollinger Band, upper Bollinger Band. Bollinger Band has three lines. We're not using the other two, so we're not showing them. Okay, the squeeze is on here. We're not using the squeeze for this particular strategy, but the squeeze indicator is on the chart. What we look for visually, and people can write software to find it in an automated way too. We're looking for the orange Donchian mean line to cross above the 40 period moving average. There are other little details to qualify this, but that's visually what we look for. So if we look on this day and we go through a list of ETFs, you go click the orange line cross the blue line, no. Next ETF, orange line cross the blue line, no. So and it goes really fast. Orange line cross the blue line, no. Next day, did orange line cross the blue line, no. Hey, orange line cross the blue line. That's how long it takes to do your analysis to see if you have something to look at. If the orange line didn't cross the blue line, you just move to the next ETF, next ETF, next ETF. Goes really fast. Okay. But if you see the orange line cross the blue line, now you stop and you go through the trading plan. You go through the detail review to make sure everything is valid. Has to close relative to the Bollinger Band. These days where it's in a the orange line is below the blue line has to be a certain number of days to make it valid. And that's really about it. So now we do this. We go to our trading plan. Our trading plan for this strategy will have win-loss stats for every ETF. You look at SPY, it might say 88% wins. Okay, what does 88% wins mean? All right, someone pull out a calculator. We're going to do some numbers here. Someone get a calculator. Average true range. Does anyone not know what ATR means? Average true range. Does anyone not know what that is? You can type it in or say you don't know or just say so. Does anyone not know what ATR is? Okay. On the chart, you'll see ATR here. It's on the bottom of the chart. You don't have to see it there. Okay, on this day, the ATR average true range, that's how much it's moving on average every 5 days, is 10.38 points or $10.38 if you want to use that. So SPY ATR on this day, when the line crossed, ATR is 10.38. We use that as a measure of volatility of the underlying. We're not doing option analysis. Our analysis is on the underlying ETF. We're going to use the options to capitalize on the opportunity. Okay. And we have very set rules for determining pricing of options and if it's too expensive. If you pay too much upfront for an option, you can get killed fast on time decay. Um, okay, so paying too much upfront will kill you versus how big your target is. We make money on the movement, on directional movement of the ETF. We need this ETF to be moving upward for us to make money. Okay, so the size, the magnitude of the movement has to be big enough to offset any of the negatives from the options like time decay, that type of thing. Because the option loses money every day, volatility drops and the option price comes down. So our price movement has to be great enough to overcome what's bringing the price of the option down. Okay. So that is the benefit of many years of doing this, because it would be hard to determine this without actually doing it. This is stuff we've learned from doing, not from theory. Okay, we learned this approach from doing it, not from theory. All right, so okay, ATR is 10.38. First calculation, the open price the next day of the ETF is 583.41. It's right up here on the data box. Open price is 583.41. I'm going to type it in the chat window. Open equals 583.41. I type 42, but it should be 41. What is that open price? What is 10.38 added to that open price? Should be 41. What is 10.38 ATR value added to that open price of 583.41? Someone type and give me that number. 10.38 the ATR on the day we had our trade signal added to the open price. 593.79. Thank you, Aaron. That is going to be our profit objective, our first profit objective. When you look at our trading plan, we're going to see the strategy. You're going to see the setup, visually what you look for, the triggers or the confirmations, and then basic trade management, and then most important things are the statistics. What is the win-loss percentage when you have a 1 ATR target? What's the win-loss percentage if you have certain bigger targets? You're going to find the bigger you expect to move, the less likely it's going to get there before option expires. Okay, so we do everything based on a 1 ATR target. So we're looking to enter this trade at or below the open price the next day. You're going to be buying one strike in the money. If it opened at 583.41, then you're looking at the 580 call option, and it's going to be at least 2 to 3 months out, depending on how it's set up, but at least 2 months out. Okay, so you're entering at or below the open price of the ETF the next day, and the first target, Aaron said, is 593.79. Okay, the high that day was 589. High this day was 588. High this day was 590. High this day was 594.50. Target was hit in 1, 2, 3, 4 days. Okay. What we do when the ETF is at or below the open price, we buy the first in the money option, call option. And it's going to be about 2 months out. When I work with you one-on-one, we get into exactly more details about that and the pricing. There's very specific rules for which option to buy. If you just buy any random option, sorry, it ain't going to work out for you. It doesn't work like that. If you buy out of the money options, it ain't going to work out for you. We don't buy out of the money options. And if you buy deep in the money options, then you're just wasting money. So all you do at some point when the ETF is at or below the open price, you place an order to buy that call contract. Once that contract is in your account, you then place a conditional order to sell at market when the ETF goes above 593.79, and then walk away and go live your life. Good till canceled. So the next day, you buy the 583 call option. It's now sitting in your account. You place the exit order, sell 1 SPY call contract when SPY is above 593.79, good till canceled. Walk away, go live your life. That's it. Nothing else to do. Go live your life. That trade's set, the trade's in place. It will be what it is. It could be anywhere from a 10 to 20 something percent return up to a 40, 50% return on a gap. Okay? You don't know what it's going to be. As long as you're trading consistently, the numbers work themselves out. Now, I just said 10 to 20 something percent. Most of these trades will be a 10 to 20 something percent return. Quick movers like this, it might be more, might be 30 something percent return. Now let's take a look at the same strategy, but on a different day, with a different situation where profits can magnify significantly. Right. Same strategy. SPY. This was on 8/30/24. Right. So same deal. We open. We have this. Let's go back here. Orange line cross the blue line. No. 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 Hey, orange line cross the blue line. We have no idea what comes next. All we know is that based upon our strategy, our stats say we have 88, 90% chance that this price will go up one ATR within the next 2 months. 88 to 90% chance price will go up one ATR from the next day's open within the next 2 months. That's all we know based on history or statistics. And that's what we live and die by, history and stats. All right. So the next day, let's say we got in right at the open, and then immediately the market drops, and you feel, well, this sucks. The moment you got into the trade. So the market the next day opened at 580, 40, 560, 47. Let's say you got a 560 call option. It's going to be a couple months out. This is September, October, it's probably a November option. Okay. And it immediately goes against you. It goes against you. And you're like, the option you just paid a bunch of money for is now worth a whole lot less, and you're feeling bad, but you got to keep in mind that's why we buy options. There is no hard stop loss. What you pay for the option is your stop loss. You're risking a percentage of your account, usually 1 to 2%, no more than 3% of the account. That is your stop loss. You cannot take a big loss on your account if you only risk 1 to 2% of the account. Minimum risk is going to be usually like $500 no matter what. But if you're only risking 1 or 2% of the account on a trade, you cannot take a big loss. You might spend $1,000 on an option, and it might now be worth 500, but it'll come right back in value. That's the thing with options. It's no hard stop. You don't have a physical stop, at least to the first target. After the first target, then we will have stop losses to maximize profits, but not up to the first target. All right, so it goes against you, and then it comes back, and you make your money. The target's going to be up here someplace. It's going to be, I think, a target I hit right here on that gap, and it's a very nice return. Once again, 15, 20 something to 20 something percent return very easily. Maybe more on the gap. Okay. Now, that would have been getting in at the open. The open was 560. Well, what if you got in? Let's say you have a life, you have a job, you have things to do, you're on vacation, you're traveling, you have family things you got to do, whatever it is. You don't get a chance to do your review and place a trade for a couple of days. Okay. So let's say you don't get to look at this stuff until 2 days later. And then you go back because once again, real life kicks in. This is not just back testing. You got to deal with reality and how to capitalize on reality. There's also the type of trade Becky looks for when she trades. You don't just get in right at the open. I don't think she's gotten up at 6:30 a.m. to trade on the West Coast in probably 15 plus years. Neither have I. Um, because we now know that we actually are better off just being patient and getting trades that happen on a pullback. So this opened at 560. I know some people I work with, they just want to get the trade over with and get into it and go live their lives. So they'll get up early, they'll get in at 560 option call contract a couple months out, and they'll have a good trade. They'll get their 15, 20 something percent return, and they're quite happy. Nothing wrong with that. And some people who just don't want to risk missing the trade, they'll do that. They'll get up, get in. I don't mind missing the trade because there's so many more trades. Not a big deal. So let's say you look at this 2 days later and you say, hey, there was a trade valid a couple days ago. It was supposed to be getting in at 560.47 up here. But as long as we are still below the entry price and the first target has not been reached yet, trade's in play. This trade could be in play for like weeks or months. Still in play. So let's say you're over here now, you're looking at it and you say, hey, I think I want to get into this trade that was valid back here. So the next day you're going to get in, it opened at 549. You should have gotten in at 560, but now you're getting in at 549. Over here, ATR is 6.4. Your target would have been this open price. Okay, calculator person again. What is 560.47, this open price, and add 640 to it? So what's 640 added to 560.47? Type it in. 640 added to 560.47. 640 added to 560.47. Someone please type in that value. 640, 6.40 added to 560.47. Anyone with a calculator doing that math? We need a number. Okay, Aaron. So the target would be 566.87. That would be a 6-point target. But because we had other things to do and life and whatever else, we didn't get to looking at this or dealing with it until a couple days later. So now we're going to get in at 549. That's more than 10 points lower. So now instead of having a $6.40 target, let's say we get in 10 points lower, we now have a $16.40 target. We're getting in at the open here. We're getting in the one strike in the money. We're going to get in at the 549 call option. The target's still the same, except now our target size is 16 points rather than 6 points because we're getting in 10 points lower. Okay. This first, if we'd gotten up here, our profit would have been in the 10 to 20 something percent, 15, 20 something percent return. By getting in down here, our profit is going to be in the 70, 80, 90 something percent return. Same trade, just different entry price. You could have gotten into this trade on this day, 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 even at the beginning of this day. Because on all these days, we were still below the entry price. As long as we're below the entry price and target's not been reached, trades in play. These are the best trades, the one you don't get into right away. And there are also ways to do that with scaling into a position also. You can get in a partial position here and then look for a pullback and get in the rest of your position. So there are different ways to even capitalize on that also. But someone who got in here is going to get a 10 to 15 to 20 something percent return. Person who got in here is going to be an exact same trade, but they're going to get in 70, 80, 90% return. Think about if you got in down here at 540 rather than 560. Now you have a 26%, a 26-point target. Same trade, but you're getting in 20 points lower. So instead of having a 640 target, you have a $26.40 target just by getting in at a different, same trade. So 20 different people taking this trade will have 20 different results depending on which day they chose to get in. Okay. So you can't, you know you'll be profitable, but you just don't know how big a profit it will be because if you're patient, the P word, You might even get in a little bit lower than expected. Instead of getting in right at 560, maybe you got in at 558. Even that, keeping thinking of what an option costs and everything, that could actually translate to 5 to 10% return higher just by getting in a point or two better than expected. So this is how we increase profits on any individual trade. Knowing the stats is how we know what to trade and um, what gives us our best opportunity to make money. So this is how we reduce losses is knowing the stats and knowing certain ETFs give you a better chance of being profitable than other ETFs. They'll all be net profitable, but some people really like to trade energy stocks and ETFs. Great, but they won't be as profitable overall as trading um, the SPY, Nasdaq, or DIA, Dow, unless you get it on pullbacks. All right, so and this particular strategy, Donchian Cross, happens just all the time. It's one of I think it might be Becky's favorite strategy, but it happens all the time. Orange line crosses blue line, boom, go. Orange line crosses blue line. There's a Bollinger Band factor in there, but it wasn't an issue there. And it happens over and over and over again. Here, orange line crosses the blue line. Let's just for fun, was this a winning trade? Let's say orange line crosses blue line, 6 open is 465, and it went as high as this is a winning trade. Within 2 days, the first target's hit. Orange line crossed the blue line. ATR is 607. It opened at 465 and it went as high as 473. It went 8 points. The target is six something. So this is your example of a fast move like this with a gap up. You're looking at about a 30% return in 2 days. Is just that. Orange line crosses the blue line, hit within 2 days, about a 30 something percent return when it gaps up like that into the target. So this happens all the time. Like I said, there's just 1 out of 6 foundation strategies. And then we have 2 separate strategies just for the Dow, Nasdaq, and S&P. But this is one of the main ones we choose. We trade on the grouping of 28 ETFs, and we have different strategies for finding market tops, different strategies for finding market bottoms, and we have strategies for everything in between, whether it's a trending market up or trending market down. So we have a couple of different strategies for trending up and trending down. So that's why when we go back to our, if I go back to, I'm going to change the share. So going back to the handout, so this is what you'll see in the handout. I put the example of our best stuff in the actual handout, the SPY. Um, and the next sheet down, you have the stats for that. DIA and QQQ for this grouping. Um, and then after that, and included XLI and XLK. XLI and XLK are heavily, probably 93% correlated to DIA with XLI, and XLK is about 93% correlated with QQQ. They're not exact, but extremely highly correlated and a lot less expensive. So not everyone can afford DIA options or QQQ options. But if you can't afford those, this is the next best bet, is to trade XLI or XLK as surrogates for those bigger ETFs. And the win-loss stats are still extremely, extremely good. Extremely good. Little bit less than, their counterparts, their bigger counterparts, but still extremely good. So, and these tend to work out really, really well when you combine them and trade them both. So you always add plus you have the XHB, IYR, and VNQ for the real estates. Also very priced reasonably to trade for smaller accounts. So there's something here for everyone. But it's very, and all the strategies are just like we just saw, where we're looking for two lines crossing up, we're looking for lines crossing down, or we're looking for a change in color. It's visually that simple to do the review. And each day I send out an email with all the trade signals every evening. So every evening I'll send out a trade signals with email with trade signals which we found. Becky does that review. I do the review on afternoons for futures and send that email out. And Becky does the review for ETFs and options and also shares in the evening. And I send that out to people after she sends that to me. So that's our breakdown in responsibility. I review futures and she reviews the ETFs and sends me that email, and then I forward that email to all the coaching clients. So you can compare what we found with what you found. And for the people I'm working with, I will hold your hand through the whole thing, basically. Whatever you need help with. Um, but we will be going through every strategy. Here's also a listing of trades over the last with just the QQQ, SPY, and DIA. So you can always go reference those if you want to. But we update the wins and losses every month. We update this trading plan stats every 3 months. So every month I'll send you up people an update on what we found that was a win or a loss. A loss meaning it expired worthless. A win meaning the first target was hit. And if what we found is different than what you're getting, then we need to look at what's going on. Because if we're showing wins and you have losses, then there's a disconnect. Something's wrong. Let's look at your trades and find out what. There cannot be a disconnect. These should match as far as wins and losses, meaning first target hit. It should match your trades. If it's not matching, we need to take a look and figure out why not, what's going on. So that's what I do with people is review their trades one on one. I don't do group sessions with coaching. Is one on one only. Another reason I do one on one is because I might have to explain something to someone three or four different ways so that they can understand it. Not everyone's the same. People who I think, some things I think that are really complicated, people get it like that. And some people that I think things I think are really simple, people take forever to get it. It's like, what do you, this is the simplest thing we do, but you're not. So I have to find different ways to explain certain things to different people because everyone has different background. Not everyone, and you might think someone who's an engineer is going to pick up on this technical stuff really quickly. No, it doesn't work like that at all. You would think so, but no. Um, when it comes to trading and money, it's different, and so everyone is different to work with. So that's why I have to individually coach people on what works for them. Everyone has different amounts of time they need, different amounts of hand holding. Some people I hear from, people who I haven't heard from for a while, is usually because they messed something up and they were embarrassed to tell me. So I always, that's just a fact of the way it is. If I don't have heard from someone for quite a while, they did something, they didn't want to admit to it. They're like, yeah, we messed up bad. We didn't want to tell you. So I encourage people to interact with me. If you mess something up, let me know right away so we can fix it. Because you got to deal with mistakes. We want to make all your mistakes in the first month and get your mistakes out of the way because you will make, no matter who you are, you're going to make every mistake in the first few weeks. And then deal with it, identify, don't do it again. All right. So, but that you have to like contact me, let me know what's going on. All right. And if you're interested in working with me on this, let me know before this week is up. And in an ideal world, the best time to trade, most profitable time to trade, I say it every single year. I say it every year is October through April. October through April is when we have the biggest trends, whether it's up or down, usually up for the end of the year, usually. But we want to be ready for October. And that might even start in September. We want to be ready for after Labor Day. That is in an ideal world. So if you want to learn these strategies, let me know ASAP so we can get you started. Make all your mistakes now, get everything in place. It'll take a couple of weeks to get everything just fine-tuned for the um I'm offering a $250 discount on the option strategies, 250 on the future strategies. Some of you already seen that presentation. Our next futures presentation is in 3 weeks on July 20th. Sunday, July 20th will be our next futures presentation. So on our meetup site, excuse me, it's on our meetup site and it's also on my website. If you're doing both, 750 discount, and these are the regular prices here. Everything's one-on-one. I send you an email every day with the trades we find valid. I will literally be on Zoom with you if needed to place the trades with you and make sure everything is all the orders are right because the hardest thing is to get your entry and exit orders right the first time. No matter who you are, that's the hardest part because you want to get that right. You can't mess that up. Um, so I will, if you're local, I can meet with you in person in Santa Clara. If you want to meet in person, I'm good with that. Otherwise, Zoom is the thing now. So either Zoom or in person, I'm good either way. I like to meet people in person if possible, at least once, you know. And I'll make sure the computers are set up. The software we've been using for analysis is NinjaTrader. NinjaTrader is great for analysis, but Thinkorswim is okay also for the ETFs and options. Okay. So Rob K, yeah, I love in person, and we can meet up in Santa Clara. We just set up a time. Um, and you, when I just ask people who are doing this with me to commit to 3 to 6 months of trading the strategies because it takes that long to see the numbers work out. You're going to find you might have 15 trades in your account at the same time live, and literally all 15 are going against you simultaneously. They're all in the red, all 15. You got half long and half short, and they're all going against you. And in your mind, you're going to be thinking, this was the worst idea you ever had to sign up with this dude to teach you, to coach you on options. Look at my account. Everything's red. I'm going to wipe out my whole account. It's just, that's where you'll be thinking. And then guess what? All of a sudden, somehow, some way, 85% of those trades will end up reaching the first target before expiration. And that is why you have to commit at least 3 to 6 months to see this work because you're going to be cussing my name at some point in time when they're all going against you. It happens to everyone. And it's my job to just keep you focused, keep placing trades. You're gonna be like, but I have 15 trades on, they're all in the red. You want me to place more trades? Yes. And yes. Because you don't know which trades will be the wins, which will be the losses, but you always have to keep placing more trades. It's purely a numbers thing. You need realistically 85 to 87% wins guarantees profitability unless you get in at better than expected prices, then that changes everything. You get in a couple of trades like we went over where you get in a better price than expected. Well, one of those wins is equivalent to three wins getting into the open is equal. Well, one win getting in at a better price is equal to three wins getting in at the open. So that's why getting in at a better price than expected is so key. Do that a couple times a year or whenever you can, and it does make a huge difference in your P&L and how much you feel good about what you're doing also. I'd rather see a 70, 80, 90% return on my trade than a 10 to 15 or 20% return, which is great. But you would think about how many trades you need to offset a loss. You got to think about that too. So getting a couple of bigger trades, bigger wins, you need fewer trades, fewer winners to offset losers. It's just numbers. But like I said, we've been doing this for a long time, so we know everything works. And we know we just buy calls and puts because one of the big problem people had, you buy calls and puts, they expire worthless. So, but how much time is in the option is key. That's where GAN training really helped me a lot understanding time and price. So not just price, but time. That's so key and made me appreciate that. But we got it dialed in to just a routine now as far as time in the option. All right. So right now, the market has basically been doing what it's supposed to be doing statistically. We'll probably see a pullback. Don't know how big, but some pullback in August. We're still in big bull mode. as you saw when we ran over earlier. We normally see some kind of pullback in August. So I expect that to happen, and then we look for a rally in the end of September, sometime in October timeframe. But like I said, the biggest trends happen end of year and the beginning of the year. So that's why you want to be ready now for when we get to that point. Make all your mistakes now and help you fine tune that. I do have just one-on-one with me. All right. Do we have any questions so far on anything? And looking at that big picture chart, even if you're not trading with me and my strategies, if whatever you're doing, you can time with those big picture movements, the pullback to the monthly 8 or the pullback to the monthly 40, even if you time your long strategies with those pullbacks, you're going to see some really great results. Okay, really great results. You just have to give the option enough time to make money without before its expiration. Right. So if we don't have any questions, we're gonna um, end this meetup and resume in 3 weeks from today. I think it's 3 weeks from today. Yeah. That'll be our first futures meetup in the last month or two. And we're looking with the futures, that's more predictable income. The first couple of months for the year so far has been kind of up and down, up and down, up and down with the futures. And now we're in a big upward part of that move. So we had a couple of losing months, a couple of winning months. So it's all break even. And then we started having winning months. So now we're in that ramping up mode for the future. So if you're looking to trade futures, now's the time also to do that because it looks like the losing months are behind us statistically. So we're looking at a really good finish to the year, the last 6 months of the year on the futures also. So we'll start that in July 20th. All right. So if you need to reach me, my information is on the handout. It's also on our website. If you haven't been to the website, I'm going to show you that real quick so you can take a look at what we have there. Here's my website homepage. These are the next meetups coming up for the futures. Um, this is a podcast someone did with me a year or two ago. I didn't know what they were going to ask, so I just went with it. So it gives you a good bit about me and what I do and my personality also. Um, Things we trade, a couple of the videos you can watch on some of the different strategies. This is 1 year worth of trades on one chart. How the history of this is I had one coaching client and they only wanted to trade NASDAQ and nothing else, nothing but NASDAQ. I was like, but you won't have that many trades. And they didn't care. So just for fun, I decided to take all the NASDAQ trades on the Qs in 1 year and put them on one chart. This was during COVID year again. And it was only 90 something percent wins, 41 trades with 3 losses. Okay. That's all they traded was the NASDAQ. They don't want to trade and nothing else but NASDAQ. That's why trading indices are the best. So they learn all the strategies that go with the indices and they just traded them. But that's when you put it all in one chart, that's what it looks like. And 41 trades, 3 losses. That's how we trade. But I like this visual. If you take the time to do this, I know one other person who did the same visual just because he wanted to see what it looked like. And it's a good exercise to go through. Really good exercise. Because seeing it visually is so key. Um, The spreadsheets, like I said, are available here, the handouts. You got different listings of weekly trades, daily trades, so um, things you can sort through yourselves and the different strategies. And same information for coaching details are on here. It's futures, options and futures combined, and here the options one. And the 250 is going to be off this price. All right, so I'm going to end the meetup now. And then need to reach me, you know how to reach me, contact me off the website or email me or call me.